Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and the short term is about confidence and sentiment. In this month's LONGWave video, I'd like to discuss what we are seeing actually in our MATA SII charts. As such, I'd like to cover those items shown here. I'd like to begin this session with a discussion regarding the intra-market signals and what prompted us in Q4 2018 to call 2019 as likely to be the year of the right shoulder. Let's start with the currency market and specifically the US dollar. The chart I show here we drew not long after the financial crisis. This elliptical theory chart has turned out to be an extraordinary chart in calling both the bottom in the US dollar and the time frame of its expected rally. You can see it hit our high probability target zones, that is, the circles located on the right side of the ellipse ring. We are now, however, at a very critical time regarding the dollar and whether it follows the ellipse higher or trades within the red channel. On a more detailed view, which you can find on the MATA SII site, you'll see we have broken outside the ellipse with significant overhead resistance, not much higher than we are presently trading on the dollar. This dollar chart shows that we appear to be within an ending diagonal pattern, pointing us towards a right shoulder, terminating in 2019, before heading lower into the presidential election cycle year. Quantitative tightening and higher rates have been good for the dollar since they were initiated, but both are being reversed since the Fed recently changed policy direction guidance. There appears to be more lift left in the US dollar, likely a flight to safety shock of some sort, Brexit, a geopolitical event, or something, before heading lower. The bond market, on the other hand, as represented by the 10-year US Treasury, is also signaling a possible right shoulder in 2019. This Tnx chart of the 10 years yield, which we initiated in 2016, has also turned out to be very accurate, and you have seen it many times as it has unfolded. We are not sure we have quite found the bottom in this drop in yields, but do see 10-year yields rising towards 2.8 to 3.05 later in 2019. We noted that last week Morgan Stanley changed their year-end yield target also to 2.8%. I need to add that neither of us are in the mainstream on this outlook. A ratio that has helped us significantly over the years is the SPX to Tnx ratio plotted on a log scale. We see yet another head and shoulders here within a clearly emerging dome top. The ratio suggests for this to occur we need to see yields fall further while equities continue to strengthen, at least in the short to intermediate term in 2019. We see this to be the case in the 10-year US Treasury, but what about equities? This is another chart you have seen many times as it has unfolded. As you no doubt recall, we called the bounce to the right shoulder prior to the bottom reversal shown at the bottom of the chart. Though we called for a W bottom versus a V, we were fairly accurate on the level we would reach to achieve our forecasted right shoulder. We took less time than we predicted and also broke the black trend line, which we initially felt would contain the lift. We are watching closely now to see whether the dotted black line holds or whether we lift higher than originally anticipated towards the labeled convergence shown by question marks. Increasingly strong expectations for a Chinese trade agreement may be the trigger for this, which would likely be a buy on the rumor, sell on the news event. Shown here is the Dow Jones Industrial Average chart we have also had in place since early 2018. The right shoulder is higher in the Dow Jones Industrial Average, and this may be the final level we see, being a slightly different pattern than the S&P 500. Time will tell, but you can see why we call 2019 the year of the right shoulder, and that appears to have been a great call, so far at least. Another chart to watch is credit as represented by high-yield bonds. We show here the junk ETF for the higher credit risk junk bonds. The year-end reversal has been absolutely dramatic. Money has poured back into this higher yield area. The as yet unfilled gaps is something we are watching closely, and actually were troubled when they weren't filled when the high yield market appeared to be crashing in the fall. A little more strength would satisfy this chart. All in all, looking across the intermarket charts, we have a pretty strong case of evidence for a possible right shoulder correlation. Let's switch gears to see if we can find further evidence. In these long-wave videos, we continue to reinforce that markets in the long term are about fundamentals, in the intermediate term about risk, and in the shorter term about consumer confidence and sentiment. Let's have a quick look at each. The U.S. equity markets are still close to being overvalued by 100% based on an aggregated composite of arithmetic and geometric measures. These include the Cressmont PE, cyclical PE10, the Q ratio, and the S&P 500 composite from its regression. We are clearly at historic nosebleed levels. Analysts are now calling 4% global earnings per share growth forecast in 2019. This is down from 24% in 2018. The U.S. economic cycle is set to become the longest in history in July 2019. But U.S., Eurozone, and Chinese growth has repeatedly struggled to exceed expectations. The inability of economic growth to hit escape velocity helps explain why global profits have consistently missed expectations, most notably in Europe. Years of big upside surprises to earnings per share have typically been the result of one-off policy interventions, for example, the 2018 U.S. tax cuts. Monetary policy has resulted in a number of zombie companies, according to the OECD, and defined as companies with profits, that is, EBIT, earnings before interest and taxes, to total 536 in 2018, not far off the highs seen during the global financial crisis at 626. At 536, the number of zombie companies in the world is 13% of its total. This can't be sustained, or at least grown much further. When we look at risk, we looked at changes in the global credit default swaps, or CDSs. What stands out to us is that since June of last year, credit default swaps have deteriorated substantially, and especially in the EU and UK. Brexit has had an impact, along with the steady deterioration in EU economic growth. Financial markets are worried about slowing global trade and a looming recession, and where safety can then be found. Remember, in recessions, it's not uncommon for many stocks to lose 50% of their market capitalization, and the financial markets are acutely aware of this. Just in case you thought you had seen the last Head and Shoulders chart, here's yet another one. We have peaked during this cycle in both consumer confidence and the University of Michigan consumer sentiment. Note at the bottom that the GDP regression, shown in red, has been steadily deteriorating during this apparent topping formation. If this is a true Head and Shoulders, then this is exactly what we should expect to see. What particularly worries me is the dramatic collapse in small business optimism. It is shown here in red and overlaid onto our consumer confidence Head and Shoulders for comparison. My sense is that even though the markets are continuing to rise, there is increasing skepticism. The smart money charts show them leaving, as well as more or less a buyer's strike. The rally is being driven by forced short covering. Shorts are being targeted, and buybacks, as both Democratic and Republican parties are threatening to change the tax laws on buybacks. We may already be past the emotional peak in the market. We certainly have significant anxiety out there from both those missing the rally and actually those in it. However, doing anything about that anxiety is another matter. Complacency is at extremes. The graph shown here on the upper left is constructed by normalizing the VIX, equity volatility, the MOVE, that is the bond volatility, and the CVIX, which is the US dollar volatility, then aggregating the results into an equal weighted index. The y-axis denotes the percentage of time that the same or lower levels of aggregated volatility occurred since 2010. The current level is 1.91%, meaning that only 1.9% of the readings registered at a lower level. The market is highly complacent. There is now a belief that the central banks have investors' backs. Notice the correlation between the Morgan Stanley CI World Index and the global money supply that occurred in December. Prior to the central bank's liquidity injections, the MSCI World Index was following the Economic Surprise Index lower. That has abruptly changed. The markets are being driven by liquidity, primarily from China and Japan. This is what has pushed up high-risk credit. We showed this previously with the junk chart. Meanwhile, the yield curve, as represented between the 10-year and the 3-month T-bill, has inverted. We last saw this prior to the dot-com bubble implosion and the financial crisis. Both preceded recessions. Everything seems to be indicating the same outlook ahead, and that is a recession in 2020. As we outlined in a previous video, we believe inflation lies ahead despite the 4 Ds. Ds for deflation is presently being driven by excess debt, demographics, bank deleveraging, and technology disruption. Though all will continue globally for the foreseeable future, what is beginning to occur in the U.S. is an inability to fund government debt. The U.S. dependency on foreign buyers to buy increasing levels of U.S. debt is a major problem. This will push up interest rates in the U.S., which will foster inflation in an economy now built on low finance rates. This year's thesis paper on de-dollarization lays out the case for this. However, this year's thesis paper doesn't discuss additional compounding problems, such as an unfunded $84 trillion entitlements problem that is presently being fictitiously held together by holding U.S. Treasury bills as assets, which will soon have to be sold to pay the entitlements. That will drive up interest rates. A $210 trillion fiscal gap consisting of massive contingent liabilities that are likely to have to be paid in some manner or at some amount if the global economy experiences anything close to chronic slowing growth, even 1 to 3%, and we're talking anywhere from $2 to $6 trillion. Underfunded and aging national infrastructure is also a problem, and more, as we outlined in our video on growing services inflation within a services economy. Remember, however, inflation is first and foremost a currency event, and that's what lies ahead for the U.S. It isn't just inflation in the near term, it's going to be potentially hyperinflation in the long term. At least currently in theory, but never ever underestimate what the powers to be will do by changing the rules as we currently understand them. The bond market and the S&P 500 have diverged with the jaws of death. This last occurred prior to the 2008 financial crisis. It took about 9 months to close before both headed lower, again later in 2019. Rates as shown in the top left graphic have plummeted based on the rate of global economic slowing. The signs are everywhere if we simply choose to acknowledge them. Our broad-based SII watch lists are also sending us signals. Our recent addition of late-cycle sectors such as consumer staples, utilities, and healthcare are seeing significant movement after only a very brief period of introduction, further reinforcing that we are very late in the cycle. We are concerned about Q1 earnings and most importantly forward corporate earnings guidance. We suspect this quarter's earnings may begin the closure of the jaws we just looked at. There is little doubt that the Federal Reserve will soon attempt to lower rates, but it doesn't control the long end of the curve without introducing QE4. Credit is not growing fast enough, and therefore presently the wealth effect, that is, the wealth effect to the wealthy who have the money to invest further in financial assets, is where it's occurring. It isn't Main Street. The investing is coming from the wealthy, and this must be maintained if a recession is to be pushed out. However, it is simply compounding the inequality that is now becoming global in nature. To put this all into perspective, between 1952 and 2009, every time credit expanded by less than 2%, the U.S. went into a recession. Adjusted for inflation in 2018, total credit increased by only 1.9%, down from 2.2% in 2017 and 2.7% in 2016. Taking rates down dramatically is likely not going to be enough, especially as price inflation picks up and salary and labor pressures continue to mount. The key dates to watch between now and August 1st are shown here. I always end with a reminder that they will print the money to solve these and all problems. It is the only answers politicians will ever agree on. As these two charts show, both China and Japan clearly understand what needs to be done. When the Bank of Japan's estimated aggregated ETF balance totals $29 trillion as it does today, that's about $250 billion. And this is just for ETFs, and they own other stocks within the market outright, you know it's only a matter of time before other central banks follow suit to keep asset prices from falling. They will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically, and clearly the central banks are currently trapped. That is, until they change the rules in some fashion. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2019 be an outstanding investment year for you and your family. I sincerely thank you for listening.